Hello everyone and welcome back. Happy New Year. Hope everyone is doing well. This is going to be my first video in a while on economic analysis. So let's just dive right into it. So I thought I'd start off the new year by taking a look at the top 10 largest holdings in the S&P 500, specifically the Vanguard S&P 500 ETF. And as you can see, we have a lot of our favorites here: Apple, Microsoft, Alphabet, Amazon, Tesla, of course, Meta Platforms, which is, again, just Facebook, but they did change their name, NVIDIA, Berkshire Hathaway, United Health Group, which is an insurance company for health, so health insurance, and then JP Morgan Chase for the 10th spot. Now, what I want everyone to pay attention to is this number right here. What this number represents, the 30.4%, this means that these top 10 companies alone, out of the 500 companies within this index, these 10 companies make up almost a third of the entire weighting of this entire index. That's mind-blowing. And I want to emphasize this because in the months prior, this was actually below 30%. And it's been steadily increasing over the months. And this is probably the largest reading I've seen. And I think it's going to get much larger. Now, why is it that these top 10 companies are making up a larger and larger share of the top 10 holdings? Well, there's two main reasons. The first main reason is that there's still a lot of money being put into these companies to basically stabilize them. If you've noticed the price action, for instance, like in Apple and Microsoft, they've basically been on an endless march higher, and there just seems to be nothing that can really beat them down. So for the most part, they've held their ground and continue going higher, while, and this leads into my second point, while smaller and medium-sized companies are getting absolutely destroyed. Let me show you what I mean. So this is Zillow right here. This company reached like in the 200s at its zenith, and that was absolutely insane. I mean, I was already saying that it was overvalued in the hundreds range, but 200, obviously we're not at those levels anymore. We are at around 54.22 here. That represents approximately a 75% haircut from its 52-week high. Let's look at another one. Peloton. This was their IPO price. So people made a lot of money, but basically made a round trip. It's back down to $31.83 here from a 52-week high of about 170. Let's just look at one more here. Rivian, this company that hasn't produced anything yet, they IPO'd and went to the stratosphere here. 179 about as the 52-week high here. I mean, they haven't even traded for 52 weeks yet, but that's the high. And now we are at below IPO prices at $69.40. Now, I'm looking at these companies because these companies are definitely not the top 10 largest companies or among the top companies in the S&P 500, but they are still sizable. Like, these companies are in the tens of billions of dollars in terms of market cap. So they're not small. They're pretty sizable, and they have fallen pretty significantly, and this is representative of what has happened to many other smaller and medium-sized companies within the S&P 500. So what happens when the stock price of these companies that outnumber the top 10 largest holdings by a lot? What happens when they fall this much? Well, their weighting decreases significantly, and as a result, these top 10 companies who've, for the most part, been flat or still managing to hold their ground, they end up getting a larger share of the pie, So that's why their weighting overall has been steadily increasing over the recent months. And that is usually what we see before a recession, depression, or major downturn in the markets of some sort. And why I say that? Well, usually before, like, the events preceding a market crash, it's not something that just happens overnight, right? It's not like, oh, it's roses and sunshines and rainbows and all of a sudden drop. No, that's not how it works. Usually what happens is you have these small companies start rolling over first. Then you have the medium-sized companies starting to roll over. Then the bigger companies like the Amazon, Apple, Meta platforms, I still like to call them Facebook, but these companies then start to roll over too. And actually, we are seeing signs of that. The fact that the Fed is talking about raising interest rates and also at a much faster pace is not really helping these tech companies, which like cheap debt. But anyways, these companies are actually starting to roll over a little bit too. The main point of me stating all of this, and I hope you sticked around for this because I haven't even gotten to the main point yet, but the reason I point all of this out is that the market is entering a more volatile period of time. Inflation is raging out of control, and the Fed has a very difficult choice to make here. We really need to tread carefully here, but am I saying withdraw 100% of funds from the stock market and stay 100% cash? No, you can't really afford to do that because you need to stay invested in this market. Inflation is so out of control that a lot of stocks will benefit, especially the ones I've been talking about, which, the commodity related stocks, those are still doing very well. You still need to be invested in stocks. Now, I'm not saying any stock, right? Obviously, if you've been buying the dips in these companies like Zillow, Peloton, Rivian, you've been catching a falling knives. I mean, it's been painful, and I mean, who knows when they'll ever reach those highs again. If you're holding the bag up there, so you can't just go out there and buy any company. You want to still be invested, but in quality names, like, the larger companies that have good balance sheets, have good financials, not that much debt, or even commodity stocks, miners, these companies that have really good balance sheets and they're still paying out dividends. And you know that they're going to do good because the price of commodities keep going up. So then what happens there? Well, they earn more profits and that's good for the company. And as a result, the stock price. So you still need to be invested somewhat. You just cannot afford not to be. You need to keep up with inflation. I also would like to emphasize, at least in what I'm doing, right? And again, everything I'm saying here is not financial advice. I'm just saying what I'm doing here. And I am staying invested in these markets in specific names, not just anything, right? And also holding on to cash because we are entering a period of a lot of volatility and usually a lot of deals tend to pop up during those times. So you want to have some dry powder to take advantage of those dips in, good names, again, not just anything. Anyways, that is basically it. I hope that was helpful. And I mean, if you guys have any questions or comments, feel free to reach out. Please like, share, and subscribe. And I'll see you all in the next one.